prefer to have a small but steady salary for your entire life, or instead to have no income except for a lottery ticket that might pay you a huge jackpot?
Well, I certainly find the prospects of a jackpot appealing, but even I know that the odds of that are low, which means that the odds of poverty are really high.
Now let me ask you a variation. Would you prefer to make a small but steady stream of payments all your life, or instead to pay nothing, but risk losing everything in one large and catastrophic event?
So I can either pay a little bit all the time, or risk paying a huge amount all at once?
Yes.
Neither.
I'm afraid life isn't going to let you get out of this choice. We all face the possibility of crippling losses. Car crashes, home fires, robberies, floods. Lots of bad things can happen. Generally, the risks are low, but the losses could be huge.
No way! I'm young, healthy, careful, and filled with awareness.
Are you immortal?
I might be. I honestly don't know yet.
One of the risks that we also face is death, and I'm going to guess you're not going to avoid that one. So the financial question is, what is the best way of dealing with these risks?
We could just man up about them.
Or we could plan for them. Humans have long had a pretty simple tool for converting rare but catastrophic losses into small but manageable payments.
What simple tool? Oh wait, I know. The flint arrowhead.
Insurance.
Was that like a pulley?
Insurance is simply the transfer of loss from one party to another in exchange for payment. Insurance is simply a means of spreading out the spikes of risk by spreading them across a broad base. It's a little bit like taking a dollop of peanut butter and spreading it across a large piece of bread.
I like PB&J as much as the next Patriot. But what's so great about guaranteeing constant payments? Why not just take your chances?
Plenty of people do take their chances. And if the risk of loss isn't that large, it's probably wiser to do that. But paying for insurance makes sure that no one sudden and crippling loss ruins your life financially. And so insurance allows you to plan your affairs with greater predictability.
All right. How much do I have to pay you?
You won't be paying me. Insurance works best when you operate in a large insurance pool. That way, you'll have a large number of people paying into the pool, but only a small group of people getting paid out. And that will keep the costs low and affordable.
So how much are these payments?
Calculating an insurance premium is a very complicated task. And surely every insurance company would like to charge its clients a lot of money to make sure that it never pays out more than it takes in. But because of supply and demand, any insurance company that charges too much will be beaten in a competitive market by insurance companies charging a more affordable premium.
All right. Supply and demand rides to the rescue again. But somebody's still got to do the math, right?
Lots of math. Insurance computations are a little bit like pension computations. The insurance companies need to make accurate guesses about how likely the risk of loss will be, how large the loss will be if and when it occurs, and how much money can they make investing your premium in advance to make sure they have enough money to make payouts later on.
Yikes, that is a big slide rule.
Typically, the tool of choice is an actuarial table.
Just glad I don't have to do it.
You do it all the time. Most of us self-insure. We tuck away small payments to cover ourselves against future contingencies. And more formally, businesses may do this as well by sequestering certain sums of money to insure themselves against future losses.
What if they calculate wrong?
They could take a very large hit that they're not prepared for, and that'll hurt their bottom line.
Hey, what if an insurance company calculates wrong?
Ah, you've spotted that risk.
I have indeed.
Well, it's just another risk. And we have a tool for managing risk.
Do we? What is it?
Insurance.
Insurance companies will insure themselves against being bad insurance companies?
Yes, they'll buy reinsurance from other insurance companies, and that will spread their risks throughout even larger and more effective insurance pools.
So it's insurance all the way up. This is perfect. We've eliminated all risk.
No, we certainly have not. There are lots of complications and limitations of insurance, putting aside the fact that a lot of people don't buy any or enough insurance to cover themselves.
Like what?
Insurance policies are extremely complex, and there's moral hazard.
This is a discussion of finance. Let's leave morality out of it.
If somebody buys insurance and believes they no longer need to worry about being careful, they're likely to engage in even riskier behavior. That's moral hazard.
They'll drive faster, they'll go to the ER more, and they'll run their insurance companies sloppier.
They might, and if they do, it'll lead to more payouts and drive the cost of insurance up for everybody.
Wait a second. Are you trying to reform healthcare and Medicare?
I'm just talking about all insurance in general terms. But there are tools to address moral hazard. Insurance companies force us to pay deductibles, which are small but unpleasant payments that we have to make in order to dissuade us from making too many claims.
What does this have to do with businesses?
Businesses are amongst the most avid consumers of insurance. Remember our discussion of limited liability in American businesses?
I'm remembering.
If you're running a sole proprietorship or a partnership, that means you do not enjoy limited liability. And that in turn means that the investors in that business might be personally liable for the business's losses.
Yes, always left a bad taste in my mouth.
Most prudent business owners will buy insurance to cover those potential losses. In essence, they'll create their own private form of limited liability.
Cool! We don't need no stinking legislators.
Now think about who else bears risks in a limited liability system. People who lend money to or do business with a corporation run the risk of not being repaid if the corporation doesn't have enough assets to satisfy its obligations. Those people can't go to the investors because there's limited liability, but they can insure themselves against those kinds of losses.
So wait, it doesn't matter whether a business does or doesn't have limited liability?
There certainly are benefits to having that entitlement set in favor or against your original position. But in a competitive marketplace, without too many transaction costs, people can certainly order their affairs themselves.
Ooh, I know that theorem. That's Ronald Coase, baby!